and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host Pushpendra Mehta, Executive Writer at CTMfile. We are very excited to welcome back Anthony Carfang, Managing Director of the Carfang Group, and Paul Galloway, Senior Advisor, Strategic Treasurer, for today's episode. Welcome, gentlemen.
Glad to be here, Push.
Yeah, thanks, Push.
Thank you so much for your time and your valuable insights. Tony and Paul, it's time to get some deeper analysis and insights from you on our themes for today, namely USP takeover of Credit Suisse, bank failures, US economy and tightening lending standards, instant payments, and finally cash forecasting and working capital solutions for Treasury. Listeners of this podcast can read these articles and also review a variety of Treasury content by visiting CTMfile.com or by following the links in our show notes. Let's start today's discussion with the news piece that UBS is buying Credit Suisse in an emergency rescue deal aimed at stemming financial market panic unleashed by the failure of two American banks earlier this month. UBS is paying 3 billion Swiss francs or US $3.25 billion for Credit Suisse, about 60% less than the bank was worth when markets closed on Friday, March the 17th. Credit Suisse has been losing the trust of investors and customers for years, and in 2022, it recorded its worst loss since the global financial crisis. But confidence collapsed last week after it acknowledged material weakness in its bookkeeping, and as the demise of Silicon Valley Bank and Signature Bank spread far about weaker institutions at a time when soaring interest rates have undermined the value of some financial assets. Tony, if I may start with you, do you think the Credit Suisse takeover will ease strains in global funding markets and lend stability to the banking sector?
Well, Push, I think the rescue of Credit Suisse certainly helps calm the markets in the short run, but it remains to be seen in the long run. This was a forced acquisition. Credit Suisse had no leverage. As a matter of fact, the market price, or the price that they got, was less than half of the market price at the previous close, and the Swiss National Bank had to guarantee about $9 billion of potential losses to UBS. This creates a $5 trillion behemoth as a bank, maybe the largest bank in the world at this point, before they start shedding assets and losing deposits. One of the things that is destabilizing to the market, and there's a little bit written about this, but not a whole lot, are the COCO bonds. The contingent convertibles, sometimes known as the additional tier number one. Coming out of the financial crisis, European banks especially issued a new tier of bonds that could be involuntarily converted into equity should the bank need additional equity. So it was sort of a buffer to absorb losses. These were bonds, they paid attractive interest, but could be involuntarily converted to equity. In this case, they were simply wiped out. Not involuntarily converted to equity and getting part of the $3 billion purchase price, but completely wiped out. That is sending shivers through the European bond market and could cause problems of its own. There are investors that there's about $250 billion worth of these kind of bonds outstanding, mostly from the biggest European banks. So while we may have solved the Credit Suisse problem, you squeeze the balloon and the problem goes somewhere else, but still within the boundaries of continental Europe there.
You brought up a point that was just rolling around in my mind with regards to Credit Suisse. I was in the trenches trying to raise capital in '08 and '09 when the financial crisis happened back then. Lehman failing, B of A being forced by the government to acquire Merrill Lynch. And this just brings back a lot of those days. And some of the issues I have with this is, the bondholders received nothing, but, the equity holders were saved. I have a problem with bailouts because of moral hazard. Moral hazard got let out '08, '09. People got saved. Was it worth it? Well, maybe it was. The economic or the economist within me says, you should just let them fail. But, if we let them all fail, what's that mean for everybody else? Well, it probably means we're all going down with a lot of pain for a significant amount of time. This takeover by UBS, boy, they really are going to come out smelling pretty good, I think. This seems like a good deal for them.
It's not unlike the J.P. Morgan's takeover of Washington Mutual and Bear Stearns at deep discount prices and would help build the franchise. I'll point out that Credit Suisse was an active player during the financial crisis of 2008 with their structured investment vehicles and whatever. They have been somewhat limping along ever since, marginally successful, but certainly a lot of bumps in the road. And, I would speculate that, the Swiss wanted to maintain two strong banks inside of Switzerland and not combine them into just one big bank that dominates the entire market. But they simply weren't able to do it. I think the problems at Credit Suisse actually ran pretty deep. The CEOs were turning over every 18 to 24 months. You had regulatory issues. They got into crypto problems. They seem to be aggressive at pushing the limits of what a bank could do. Not inappropriately so, but you need the right risk management, the capital position, and the earning power and the muscle to be able to do that.
Yeah, definitely agree with that. I recall, this was back in between '06 and '08. We would have the Credit Suisse bankers come in several times a year. Post that, they quit coming. We didn't see them again. And, the financial crisis really, really hurt them. And I think you're right. They just never found their footing after that. They just were they were destabilized. They couldn't seem to, find an identity. They were doing things that just were outside of their core competencies. And, it finally came to a head here. We've been seeing the headlines for couple months now. They've been in the headlines. It's kind of crazy how long it took to get to the point where, okay, it's done. I think last week's announcement was just, the peg or the peg that got pulled that just toppled it all over.
Right, and Paul, I couldn't agree with you more. The writing was on the wall. Moving forward to our next story, that pertains to stress among small banks, banking failures, and tightening lending standards. As stress ripples through smaller banks in the US, the tightening in lending standards among those institutions is expected to reduce economic growth this year, according to Goldman Sachs research. Tony, do you think the recent bank collapses will likely result in lenders pulling back on corporate lending? And if so, how will that impact corporate treasury?
I do think that lenders are going to pull back, not so much because they are suffering from the same problems that were exhibited at First Republic or SVB or other banks, but simply because of the uncertainty in the marketplace and the uncertainty in the regulatory environment. Some of the nonsense we hear coming out about we need to, put tighter controls on and do more regulation and rein banks of all sizes in. And statements like, well, we there must be problems out there, so let's insure all deposits, raise questions about the viability of banks of all sizes. And then other statements on the part of legislators and regulators that say, well, if we're going to extend deposit insurance, there are going to be some regulatory strings attached, which sounds very vindictive. If I'm a CEO of a community bank, I'm going to say, well, I'm not going to take any chances here. I'm going to shore up my capital. I'm going to, tweak my loan to deposit ratio. I'm going to raise my credit standards so I don't have any write-offs. And that's simply the unfortunate consequence of all the hysteria around the current crisis. If you look at the balance sheets of, once you get beyond banks, below banks with $100 billion of assets, we've got highly capitalized banks. We have banks with not only good capital ratios, but good balance between time deposits and transaction deposits. We have banks that have a high level of insured deposits, all of which make the depositors safe. Makes the deposit sticky, so there's unlikely to be a mass movement of deposits out of the bank. There's no reason for a depositor whose deposits are fully insured to move. We have a very strong banking system. On one hand, though, there's so much confusion here. We have the Secretary of the Treasury 2 days ago saying the banking system is strong. The U.S. banking system is very strong. And then yesterday she says, but we need to extend deposit insurance to protect the banking system. Well, okay, how do you hold both of those thoughts in your head at the same time? And again, back to my point, if I'm the CEO of a community bank, I'm going to say, whoa, let's just pull back a little bit, let the dust settle, which is unfortunate. It's going to be unfortunate for small businesses. It's going to be unfortunate for the economy.
Yeah, Tony, I think that's spot on. When I think about Signature Bank, Silvergate, SVB, how fast they collapsed, we're seeing signs that there's other banks that may potentially be going. It's not going to surprise me to see a few more banks go. I think you're right in terms of banks of all sizes. They're looking at their balance sheets. They're looking at their loan ratios. They're going to shore up those pieces. And they don't need regulators to tell them they need to do this. They're doing this because this is what happens in free capital markets, is when things become stressful, the leaders of those organizations are going to make decisions generally that are going to put them in position to weather the storm. They're not going to just let things continue to go. As I know if they do, they're going to get gobbled up just like the other banks that are failing. And so they don't want to fail. And so I do think that the free markets are going to work and they're going to be able to regulate themselves to avoid riskier behaviors along the way. I do have some concerns about FDIC expansion this way. Mm-hmm. If you want to have that conversation, do it at a time where we're not in times of stress. Don't do it then. Let's have the open conversation. And, those levels have been in place for a long time. They have been. And it may be time to have the conversation about is it the right level or not. But to tie it to stricter regulation, I'm not sure that's the right answer. So I do have concerns over that.
Yeah, if you look at the history of deposit insurance, Paul, I remember back, it dates me a little bit, but with the passage of the Monetary Control Act, the deposit insurance used to be just a few $1,000s. One branch of Congress proposed in that bill a deposit insurance limit of $10,000. The other branch, $20,000. And in the compromise committee, they settled on $100,000. And and it remained $100,000 until the financial crisis of 2008. In which case, then they bumped it up to 250. Then they went unlimited for 2 years, and then back down to the current 250. It's just interesting to see how that all worked.
It is. It really is. That's an interesting piece of history that I didn't know about. I guess I need to do a little more research.
It was like during the S&L crisis that we go from 10 to 100, and then the global financial crisis that we go from 100 to unlimited, and then back to 250. And now here we are again, raising the issue. Frankly, for businesses, 250,000 is not enough to ensure their operating cash.
It's not. It's not, and I can tell you I sit on a finance council and a trustee at a church. Our church is not massive in size, but I'll say that, we're struggling with the $250,000 limit ourselves, and our diocese requires that we have one bank. We've got to shop around on parking money, and it's a big challenge for a small church to go do all this.
Up until about 2016, most companies would set up a sweep account at their bank and sweep everything over the $250,000 insurance limit into a prime money market fund. But the SEC's regulations, again, regulators coming down, tweaking prime money market funds, requiring them to carry their value out to the fourth decimal place, made it impossible to use a prime money market fund operationally for a sweep account. And that gives rise to uninsured deposits. It's kind of ironic that we're worried about the fourth decimal place on money market mutual funds, but Silicon Valley can buy $94 billion worth of mortgage-backed securities, put them high to maturity, and oh wow.
It's bizarre.
A couple of other factors there. The explosion of uninsured deposits. A couple of things happened. As the Fed pumps up the money supply, the money the money goes into the banking system. A year or two ago, the exemption to the Basel III supplemental leverage ratio that allowed banks to add unlimited amounts of government securities on their balance sheet, that went away. So the biggest banks had to turn away deposits, which pushes deposits into banks like Silicon Valley. At the same time, the regulatory problems that Wells Fargo was having, the CFPB put a cap on the amount that Wells Fargo could grow. Well, the California economy is growing. Wells Fargo can't take on, can't grow. Silicon Valley is the next biggest California bank. The Band-Aid caused the infection.
The Band-Aid caused the infection. And, as a follow-up question to all the insightful analysis and comments that Tony and Paul, you have provided on the bank failure so far, I would like to ask you, Tony, first, and Paul, you could chime in as well. Goldman Sachs economists have penciled in a pause in Fed hikes for their monetary policy meeting starting today. The stormy financial conditions do pose a dilemma for the Fed. Do you think the Fed will remain focused on high inflation and price stability and announce a rate hike of 0.5% or 0.25%? Or will the Fed choose financial stability over price stability as the priority and hold rates flat until the markets have settled and concerns around the broader financial sector stress have been assuaged?
If you remember back in 2018, the Fed was planning on getting its balance sheet back into order because it had doubled since the financial crisis back then. And Fed Chairman Yellen said we're going to reduce the money supply and we're going to raise interest rates a little bit. The markets reacted badly. They called that the taper tantrum, and the Fed completely backed off. End of the program, beginning of the next cycle that takes us to where we are today. I certainly hope Jerome Powell does not repeat that historic mistake. The money supply is up several fold over the last dozen years or so. The Fed's balance sheet, shot up from 1 trillion before the financial crisis in 2008 up to close to 9 trillion today. The Fed announced, that they were tapering their balance sheet and they were going to purchase or they were going to shed $95 billion worth of securities per month. At the Carfang Group, we follow this number very closely. I mean, we follow this number weekly, and they got it down to about 8.3 trillion from just under 9. Last week, it shot up $300 billion. The Fed added $300 billion to its balance sheet. It's up over 8.6 trillion again. A complete reversal. Now, you might argue that those extraordinary measures were necessary. Frankly, though, you have all this talk about bailing out, SVB or whatever. That $300 billion was enough to buy all the impaired securities of SVB, First Republic, Signature, Silvergate, and have a couple $100 billion left over. And they didn't do that. So the markets are still in turmoil. The balance sheet is expanding again. It's like long-term monetary or long-term Fed policy is like 3 days.
Yeah, Tony, I think the Fed's got to continue to do what they're doing. A couple weeks ago, with pre-SVB, I'm sitting there going, rates are going to get bumped 50 basis points. Post-SVB, you're hearing folks out there think Goldman said 0. I'm thinking it's going to be 25 basis points. I don't see them not doing a raise. They've got to continue to get that balance sheet under control. I'm not sure, with the government programs that are tied to legislature that's been approved over the past couple of years. I'm not sure, the turmoil that's happening out there, I'm not sure if they're going to be able to wind it down at a pace that would be appealing to me and you, Tony. I just have a feeling it may be in oscillating levels for a little while before we start seeing it pared down more. But I do want to see that balance sheet get under control because it expanded significantly. You think about that ninefold. I mean, that's huge. That's just too much.
Paul, we have a chart that shows going back to 1980, almost a perfectly straight line of the total assets on the Fed's balance sheet at just under 6% of U.S. GDP. Just under 6%. In 2008, that number started to tick upwards, and last year it hit 35%. Fed balance, think about the capital that is stranded when the central bank holds 35% of GDP on its balance sheet. Think about how the markets are distorted when instead of dozens or hundreds of players in the market, you have one gorilla holding 35% of the government securities of GDP. It total distortion. So, I really hope they stay the course that Powell announced several months ago. I think that was the right plan, and that would be good for the economy. I think any radical change. I think if they fail to raise rates at all, my guess is the market will see that as a negative, suspecting that there are greater problems that the Fed sees that the rest of us don't.
Yeah, I definitely agree with that. If they don't raise rates, I'm going to be very concerned.
Moving forward from the possibility of a rate hike or otherwise to the third story for today that pertains to US Federal Reserve announcing a July launch for the FedNow Service. FedNow is expected to modernize the way thousands of institutions move money and allow for greater use of instant payments at all times. Paul, Do you think FedNow will be a game changer for corporate treasury, particularly as individual transaction limits have been increased to $1 million?
Well, I think it's a good step forward. It's been a long time talking on the Treasury side of things. We want to get payments quicker. We want to be able to move that at a faster pace. The ability to do same-day ACHs when they start ticking up the limits there. Treasurers, they like that. They like to be able to do the payments a little faster. Now you've got another option here with FedNow, I think, that starts expanding that. I see those limits going up over time. What needs to happen is the adoption rate just needs to move at a quick pace to get those limits to move up. Once you get people used to using this kind of a service, then people are going to, corporations, government entities, individuals are going to demand greater access or ability to effectuate these kinds of transactions, which is going to help lower the costs associated with doing it, whether it's FedNow at a Fed level or whether it's ACHs, same day, real-time payments, anything tied to this faster, this idea of 24/7, I can make a payment and it's done. Right. It's been coming. It's been a long time coming. So I think this is a very positive step forward. I think we're going to see. I'd be surprised not to see a significant adoption of this. So I look forward to seeing how this all plays out.
I couldn't agree more with Paul. This is a major step forward to have the ability to move money, to execute payments 24/7 is huge, and the ability to move money instantly. Frankly, that takes a lot of certain risk out of the system. The clearing risk, the transaction delay risk goes away. The weekend risk, if you look at the capital markets, there are always some funky things that happen on Fridays as people position based on what they think might happen over the weekend. This lowers transaction costs significantly. It takes a lot of friction out of the system, which is very good for the financial system. And a secondary benefit is this has the wherewithal to increase the velocity of money, which is slowing considerably over the last several years. That there's been a long-term secular decline, and as we look, to tie back to the other topics that we discussed, if the Fed reduces the money supply, and that's the track that the Fed was on, gross national product, GDP, is money supply times velocity. So if you're going to reduce the money supply without reducing GDP, the way to do that is to increase velocity. And this is one way of doing that. This will allow companies and individuals to do the same amount of transactions, but maintain a slightly lower balance because they know that they'll be able to cover and replenish more quickly. So I'm all in on this.
The fourth news piece for today that warrants discussion is Citi partnering with TIS, a cloud-based provider specializing in cash forecasting and working capital solutions for CFOs, treasurers, and finance teams. Paul, from a corporate treasury perspective, can you spell out the key benefits of the Citi-TIS partnership?
Yeah, I think what you've seen out there with banks are realizing, technology is really key to keeping their business moving forward and keeping up with the demands of treasurers. In Citibank, back when I was a practitioner, they used to tout themselves as not a bank but a technology company because they would plow a lot of capital back into technology. I think this is just evidence of doing that, partnering up with TIS, which has some pretty solid technology out there. And cash forecasting from a Treasury perspective, if you're going to offer a Treasury solution, forecasting is becoming more and more important from a treasurer's perspective. The utilization of artificial intelligence, machine learning, the ability to hone in on the ebbs and flows of your cash on the books is extremely important to corporate treasurers. You can't optimize if you don't have good visibility to what your forecast is, and optimization is really key. They don't want to hold more cash than they need to, and they want to put more cash to work to get a better yield. Obviously, pre-COVID, when rates were low, getting yield on cash, sunk even further, and you basically couldn't earn anything on cash. With the rate hikes, now we're seeing that treasurers can get yield on cash. Having a forecast that gives them the ability to optimize appropriately will improve their cash yield and deliver more returns to them. So I think this is a real good partnership for both TIS and Citibank. I suspect that they've already got all their bankers teed up to sell this product or this solution across their platform.
Well, as Paul said, timing is everything. I mean, for the last dozen years, interest rates have been zero. The way I would look at that is the opportunity cost of a bad forecast is zero. So you had a good forecast, you had a bad forecast. That means you either had more money to invest at zero, or you had to borrow extra money at zero. A corporate treasurer couldn't justify huge expenses into upgrading cash forecasting system because there was so much cash there, and the cost was zero. Today, that's obviously changed quite a bit, and this is all about aggregation of data and business intelligence and using that data to run your business directly and better. We've always said that the most forensic way to analyze the health of a company is to look at its cash. What is going in and out of that cash account? That is the early warning system. Back in the old days when checks used to be mailed to lock boxes, to give you an example, just using information, artificial intelligence was kind of like knowing that a customer reliably paid you on the 15th of every month, and then all of a sudden that payment goes to the 21st. Is that a warning system to your credit manager that you have a customer who might have some sort of problem? Now, this is that on steroids, obviously, and the ability to bring in huge amounts of data for that kind of question, and just so many others, I think is a real boon to the treasurer, and it's something that the treasurer can parlay to actually strengthen the treasurer's seat at the C-suite table.
Finally, what is your choice for the biggest or most important story of the past week, and why? Paul, if I can ask you to go first.
I think one of the most interesting things that I've seen reported recently, and there's quite a few things, the banks, what's the Fed going to do, Credit Suisse bailout, Xi Jinping going and visiting Vladimir Putin. These are all great topics, but the one that just stood out as most interesting to me is former President Donald Trump coming out and saying he's going to be arrested. Well, today, that was his prediction. This is something that's unprecedented, and I don't know what's going to happen with all that, But if they do arrest him, he ends up walking away from all that at the end of it. Think about what that might do to his campaign. So if you're not a Trump fan, this kind of thing could bode really well for him, even though it sounds ominous in nature. So we haven't seen something like this before. So I'm watching to see what the headlines are going to say. Are they going to do it? I read something out there trying to figure out, do they actually cuff him? Do they do the parade? Do they not cuff him? Do they bring him in a back door? I mean, how do they handle this? They got to be questioning it. It's just I don't know. I don't know what to think about it other than I'm going to pay attention to it just to see how this unfolds.
Fascinating, Paul. I had not thought about that, but I have this image of a photo of former President Trump in handcuffs being featured in a campaign ad by his opponents against him, and being featured by him in favor of the need to change the victimization and the whole process. For me, the biggest financial story is the banking crisis stemming from a failure of supervision. Supervision on the part of the executives at Silicon Valley Bank, obviously, and the board at Silicon Valley Bank. Whether they had a risk manager in place or not, they certainly had a full risk management department in place. And the only mathematical skill you needed to have to see this problem was addition. You didn't have to know how to subtract, let alone divide or multiply. If you could add, you could see the problem, period, and end of story. Then on the part of the regulators, whose job it is to inspect and manage these, Silicon Valley had 44% of its assets in mortgage-backed securities. That's just unbelievable for a bank to have that much in mortgage-backed securities. Separately, it reported about 44% of its total balance sheet was in the held to maturity category. I don't know if that's the same 44%. It's hard to tell from the FDIC call reports, but those are red flags. We issued a report to our clients. I went back in the files, dated September 2021. That's 18 months ago. That listed the fastest growing larger banks in the U.S. And obviously, when you get to astronomical growth, that's a problem for any bank, right? Something is going on that drives that astronomical growth. And I have this table. Number one on the list was Silvergate Bank. Number two on the list was Silicon Valley. And number three on the list was Signature. That was 1, 2, 3 in the order in which they failed.
Interesting.
Not only we had the ranking right, we had the chronological order right. Pac West was on that list. Western Alliance was on that list. And First Republic was also on that top 10 list. The regulators saw this and chose. I mean, I chose to ignore it. And to me, that is what's the biggest untold story of the week.
Yeah, Tony, that's just that's really enlightening. Talking about that list, and you think about, you think. '08, we would have learned our lesson. S&L crisis, which you brought up. I was in high school when that happened. S&L crisis, financial crisis, the .com, which was completely different. But, you think about these things that generate failures along the way. You think we would learn from them and be able to prevent them from happening. Some of the challenges to that is going back to this concept of free markets and the ability to assume risk. It's by nature, it's in the free markets. There's risk out there. but the ability to manage that risk and see when you shouldn't take on more risk, there seems to be a bit of a failure there from the risk management standpoint. And if your board of directors isn't asking the questions and your risk manager isn't asking the questions or making the points that, hey, we shouldn't probably be engaging in this, that's where concerns arise. And I just hope when we walk away from this, history seems to repeat itself. I just hope that maybe we can learn from it and just not repeat, but we do seem to repeat.
Well, and in terms of history repeating itself, following every one of those crises, legislators and regulators came up with new regulations based on the notion that risk is bad and needs to be eliminated, and they developed regulations that, in a Don Quixote fashion, tilts at windmills and tries to achieve that, when in fact risk, if managed, not only is good, it's essential. It's essential to growth.
Yep, totally agree with that. It's managing the risks that's the important part. How you manage that.
Those are wise words, and I hope we can not just learn from history, but also profit from history. Thank you so much, Tony and Paul, for your discerning insights and analysis. We would also like to thank our CTMfile audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.